uh, welcome Noah Powers, who is reappointed to the commission from a previous. So welcome, Noah.
Thank you, Mr. Chairman. It's good to be back.
Okay, thank you. First item is the approval of the minutes for the January 15th, 2014 meeting.
Also moved.
I have a second.
I'll second.
All in favor?
Aye.
Aye.
As is what we have always committed to, is that there'll be public comment at any time on any of the issues that come up, and it's not just limited to the item on the agenda. With that, to get into chairman matters, I had spoken with Jim O'Connor to address two issues for us. One is just a brief update on the FP&L status, but as well to address some of the issues regarding the high-speed train commission, which in fact may generate downstream some financial issues for the city. So, Jim?
Thank you, Mr. Chairman. On the FP&L, the discussions are still going on between FP&L and FMPA. FPL is formulating their response. They have to go through the various departments and obviously their legal department as well, because the numbers are very large and they are working on that. As of yesterday, we were on the phone and still looking at options of some way of trying to give some variations that we would bring back to council for consideration. Everybody knows we have no more money on the table, so we don't have any means by which we can buy our way out of this or pay for any future issues. But we're trying to work through that, those options, and hopefully we'll bring those back relatively soon. I do not have a time frame. I know everybody would like to say on March the 31st this is all going to be resolved. I cannot say that. But I think that we are in a time period now that decisions are going to have to be made. We know what the numbers are and what the cost is going to be. The high-speed train issue is one of those that we've had, I think, 4 meetings of the this Railroad Commission. And in those discussions, we've talked about quiet zones and the need of quiet zones in an urban area such as ours. We've had Mr. Rusty Roberts, who is also a representative from All Aboard Florida, to sort of give an outline of what they're doing and what their projections are. At the last meeting, there was discussion about hiring an engineer to study the quiet zone issue. And this was predicated on the fact that All Aboard Florida says that they're in the process of doing their safety features for all the intersections. And then when they finish that study, they will come back and do the modifications to the intersections that will accommodate the high-speed trains. I had a little concern about that because, number one, I'm not sure if anybody really knows what it is we're engineering for. And I think we need to sort of step back and see what All Aboard Florida is actually going to bring to the table and what that may impact the community. The other is that, you know, I've just sort of, and I said this to Rusty Roberts of All Aboard Florida, until we see the business plan of how they're going to justify 16 trains moving through here at 110 miles an hour, on a regular basis, what the ridership, how are they going to pull this off? And I would hate to see the city invest up to $3 million in quiet zones when, in fact, it only lasts for a couple of months. The reason that the discussion has really come about is when All Aboard Florida does their improvements to the intersections. In theory, we would tie on to their contractor and there would be some economy of scale savings. I'm not sure all of that is accurate in the fact that the quiet zone construction and improvements really affect almost the other side of the track from where All Aboard Florida will be making their work. It is true they would be there on site and be able to do the work, but I think, in my opinion, the savings of that construction versus the risk that we're taking spending money on trying to design something that may or may not be needed is the issue. The other thing is, and if you read in the Federal Railroad Administration on high-speed rail, a lot of times improvements have to be made at those intersections, and they may already accommodate quiet zone improvements. And there'd be no reason for us to go and design over and above that issue. But we're going to keep track. Mr. Roberts has assured us he will continue to come to our meetings and sort of give us the time frames. And the issue really comes down to spending money versus the risk of what impact it would have on the community. And so those are the type of debates that are going on now. The chairman of the committee has got a long list of questions, and Mr. Roberts is getting those in between meetings and coming back and responding to them as quickly or as best he can.
And the issue is not only the quiet zones, but safety. In one of the discussions, extended discussions, is in fact putting fencing up, which was another issue that's under discussion and consideration.
That is true, and All Aboard Florida indicates that they're going to have to do some fencing because of the speed of trains. Now, if there's going to be additional fencing, obviously that would fall on the local government. There again, I think we as a community need to stop and think, do we want chain link fence? And they haven't committed it's going to be chain link fence, but knowing the railroad, they do low bid as everyone else does in today's world. Chain link fence running the length of the city north to south up and down the railroad tracks. I realize it's a safety issue and it's something that will have to be addressed as they go forward. But if it is a true safety issue, to me, then All Aboard Florida needs to make that accommodation. The only reason we're even involved in the quiet zone is because that's not really a safety issue. It's more of an intrinsic type of issue involving the community. We were making that decision. They are in the process of doing their impact statement, environmental impact statements. They've already done one that is a couple years old that said everything was clear and ready to go, and now they're just following up on that. They are supposed to be holding some hearings, and they did on their first in Fort Pierce. I, for one, had never heard about it, but supposedly there was a meeting down there, and they are required to do that in spaces up and down the tracks that are being affected. So we're also looking at asking, the City Council has passed a resolution asking for funding from the state. We have talked to Peter O'Brien, who is on the Regional Planning Council, and he has brought it up at the Regional Planning Council. They also have discussed it as a group because you have the population center, obviously, down in Palm Beach County. And if we went in as a whole group, because we're all going to be impacted by that, then we would stand a much better chance. There again, and the likelihood of the state paying 100% of quiet zones on the eastern seaboard of the state of Florida, I'm not sure they could afford that. But in many cases, they oftentimes will provide grant applications and a percentage paid for by the local government, and then that might help bring down some cost as well.
Commissioners?
There isn't any federal money involved in this, is there, Jim, at all?
Glenn, that's a very good question. Mr. Roberts says there is no government money involved in this at all. But if you go on the Federal Railroad Administration website, All Aboard Florida has requested a loan of $630 million. And so there has been a loan application that has been submitted. And I don't know where that is in the process. Now, would a loan be called government money? But that request has been made. I know that.
Surely by this time in their efforts, there is a pro forma projected operating statement on this thing.
That's what we're hoping for
It's gotta
too.
be someplace.
Yeah, as a private company, we cannot ask for their financials, but we have asked for the pro forma of how this is going to operate and to see what kind of studies they did. Mr. Roberts told us he would get the information that he could provide from the company to us. But a performer had to be done. If you're going to spend $2 billion, I would presume there's whoever's writing that check is going to say, how are you going to get it back to us, type of thing.
Yeah, they gotta provide.
Cindy, I don't think your
Yeah.
microphone. I don't think your microphone's on.
When they announced it, originally it was a $1 billion project 2 years ago. It's now a $1.5 billion, and that doesn't account or any of the money that the individual municipalities or communities will have to put in. And there's 138 grade crossings between Miami and Cocoa. Of course, they have to extend the line from Cocoa to Orlando Airport. But I have some reservations, being familiar with high-speed rail, that it's a 3-hour trip, which means if you do the division, is about 3 hours. It's 3 hours, and that's 80 miles an hour. So the fact that it can go 150 miles an hour is going to average 80. And that mitigates any future stops, because any stops are just completely unravel the need for a 126 plane. So, and to your point, Jim, I absolutely concur. Well, I'm skeptical in terms of what the ridership is going to be, and the viability of that plan to put in.
Absolutely.
So,
Well, we all hope that, mass transit does work. I mean, I think that ultimately we've got to come to that realization, but it's just, I use the example, and I'm not a New Yorker by any stretch of the imagination, but when you visit New York and you ride some of their trains, and Chicago the same way, they have unbelievable ridership in the numbers of people that surround those tracks, but they still get substantial amount of government subsidy. And so we're talking about, a self-supporting, but it will be a challenge. I think as we work through it, the Railroad Commission is going to be around for at least 6 months and talking and trying to work through this. According to Rusty Roberts, they hope to have people paying to buy tickets in 2015. But to my knowledge, they have not laid the first piece of track. The other element involved in all Aboard Florida are the developments at the stops in Orlando, as well as Palm Beach and in Dade County, in which they're going to have commercial activities at some of these railroad crossings, not crossings, but the railroad stops. And so that plays in their performa as well.
Commissioners, any comment?
No comment.
Welcome, Catherine. Thank you, Jim. I just wanted to put that on the radar screen because it will be coming up, and I think with a healthy dose of not cynicism or skepticism, but questioning as with all of these undecideds. Thank you. New business. We have a professional witness here, and I was wondering if.
I guess I'll lead off.
Okay.
And he can give you the engineering details. As you know, what we have recommended to the City Council and has passed on the first reading is to provide county rates to the unincorporated areas that we serve. This would exclude within the corporate limits and exclude Indian River Shores, although Indian River Shores already has that. We base our premise on that it'll be a no loss to the city. We have a GAI study that shows that our revenue stream will increase 2.58%. And based on the limited experience we have in Indian River Shores, which we show no downturn, and of course our business is predicated on weather, i.e. drier the season, the more the sales, and that's how our revenues flow. But we felt like that this seemed to be a major issue with the county, and thought we could sort of head that off at the pass. Let's just get that out of the way, because we still have a franchise agreement until March of 2017, and that will give us time to try to work through some of the other elements that the county would like to discuss in their proposal. As a matter of fact, The county attorney advised us today that he has a recommendation going to the county commission at the next county commission meeting next week. And I have sent him a few comments that I had that I feel like need to be addressed when we sit down and talk about the franchise agreement. One of the things that has been discussed is that the county now has indicated that they would like to go back and model the agreement after Indian River Shores. We have some elements that have changed since then. One is the Public Service Commission. If we come under the Public Service Commission, and the county has asked for this to occur, and our state representative responding to that request, and we have no problem with the Public Service Commission. But if the Public Service Commission does regulate our utility, they not only have input into our rates, but also our rate structure. So we can't sign a long-term agreement with anyone establishing a rate structure that the Public Service Commission may come about in 3 years and say that structure is not fair to certain classes of customers. So we would have to have some provision in the franchise agreement that says that if the Public Service Commission if we come under their jurisdiction in any form or fashion, that any agreement we have toward a rate structure would have to be void at that point. And so we would have to deal with that. The other issue that seems to be a hang-up is ownership of assets. Well, in Indian River Shores actually owned assets, gave them to us for use. But they actually installed the assets, and they had an ownership interest in those. We carved those out in our franchise agreement with Indian River Shores, that at the termination of the franchise, they would have those elements of assets back, which is a very small part of the whole system, just to put it in perspective. And Indian River Shores, as well as the unincorporated areas, because we can't just, South Beach and the unincorporated areas, and you can't just segregate South Beach. You have to take the businesses that we have surrounding our city. The county has no ownership that we can see of any of those assets whatsoever. They have not been involved in the delivery of the services and the utilities there. So that changes the game, that we wouldn't have a clause that would transfer back any assets because the county doesn't have ownership of those assets. So that will be an issue that we would have to work through. Another point that we really need to bring out when we talk about this rate structure, there are going to be, as you would have in any change in rate structures, winners and losers. The smaller user, those people at 3,000 gallons and below, will be saving money, no question about that. But you take the hospital, and the hospital is going to be hit very, very hard because they're a major consumer of water and sewer. So that's just to give you a picture of where the changes will be made. But again, based on our experience, based on the GAI study, we have no reservation about this whatsoever.
Jim, if I could, let me understand this. What you're saying, there's no impact on the city's revenue, because what you're doing is shifting the revenue cost within the county, charging some people more and charging other people less. So the net effect is zero impact in the city. I think that's what you're saying.
Right. The impact is 2.58% based on GAI, and that's a positive to us, by the way, but we look at that as negligible. Yes, the answer is, and based on our service to Indian River Shores, we find no impact and on the county rates that they have as well. So we do have sort of an experience in this.
Yeah. I have a little question here on the resolution, the third page at the end, last sentence in section 3. It allows for all other charges and fees for water and utility services to be continued to be charged as currently established. And I think, is that referring to the 6% equalization charge?
Yes. What we're doing is we're saying that the 6% equalization charge is what we charge Indian River Shores, what the county charges Sebastian, and in theirs, they do not call it a franchise fee. They call it a equalization. Is it equalization in their rates as well? Okay, so we're taking just from their structure. Also, Dan, just so there is no misunderstanding, there are some fees that we don't charge that the county does charge, and there are some fees that are a little higher. For example, when we go out and test a meter, we don't charge the first time, the county does, but we charge twice the second time, and the county is at a lower level. So some of those would equal out, but so it's not absolutely the same, but it's fairly close. But we will honor all of the issues pertaining to the classifications, your cost per where you are in your volumes.
If we weren't charging that 6% fee, would their rates to, let's use South County, they'd be paying a lower rate than the residents of Vero Beach would be paying for the water service?
Again, depends. The answer is yes. If we took 6% off the top, you definitely would lose that. But again, it depends on which class that you're in our customer and your consumption pattern.
Whether we're lower use or higher use?
If they're in the lower use, they're going to pay more in the city. If they're a higher use, for example, if we changed our rates around, the guy that flushes his commode and takes a shower and that's all would get a savings by going to the county rates. If you're Costa, a hotel, or one of those businesses, you obviously would see an impact.
The reason why I'm inquiring on this is I'm just wondering if there's any way we could get rid of the 6% equalization charge and still be financially feasible and viable. Because does this 6% charge that they're paying, does that go to the maintenance of the water and sewer facility, or does it go to the general fund?
No, it goes to the utility itself. It's collected and used in the utility for operation of the utility.
All right.
The second thing is the equalization charge, just so everybody understands, is that, what we're saying is that we want to go with what the county's charging. That's what they're charging, and that's universal through the county. So I don't know why we have a major issue of that. This is the agreement, and this is what they charge Sebastian. And if it's good enough for them to charge Sebastian, it seems to me like it would be appropriate for us.
But Jim, on the whole, is this still going to be positive from a business point of view, or is it going to be adverse to a business point of view, like the hospitals and the medical facility?
Well, it's going to be adverse to large consumers, which are typically commercial activities.
So it is a detrimental from a commercial point of view and a job development point of view. Is that what I'm hearing? I'm not putting words in. I'm just trying to.
Yeah. What you're hearing is if you are a larger consumer, you're going to pay more per unit than if you're a lower consumer. Example, using business, the answer is their bill at the hospital will have a major impact. The guy, now, if you look at it from a business standpoint, and I can try to argue it both ways, not being an attorney, don't play one on TV, but the fact is that if I make the cost of living cheap enough for your employees, then you don't mind paying the higher bill in the business. But at the same time, we don't want to tax business and they can't afford employees. So it's either way you go around. But the answer to the question is the higher the consumer. But that also impacts the people who use water for irrigation of their yard. If you don't have a well and you're not using reuse, you're going to have a major impact because you're going to go over that classification.
But those are probably minor costs. I mean, people will see them, but it's not going to be a major impact. But the hospitals and those people could see pretty substantial increases, correct?
Exactly.
Yes, sir. That's one of the reasons we've been hesitant about using county rates inside the city is because we have a lot of commercial activity that is here.
And following your other question was this question of being regulated. Is that out of our control? I mean, who has authority to make that judgment?
The state through legislation. The fact of the matter is the county has asked for the Public Service Commission for the unincorporated areas for consumers to be protected, which we have no objection to. And so I believe Debbie Mayfield is preparing legislation that would put us under the Public Service Commission. And so it is a state regulatory agency that would come under. Municipal utilities are not under Public Service Commission today, but private-owned water utilities are under PSC regulation.
Same as
We have
electric.
looked at some of those regulations and what the filings, there is a cost that the utility incurs because you have to do the filings on a periodic basis with the Public Service Commission. They're not anything we've seen there's nothing that we couldn't propose. But they do have, the Public Service Commission at that time has interfaced with your operation as to justification of cost. They also make sure your rates are adequate to cover all expenses. They also guarantee a rate of return, and they want to make sure the classes of customers are protected as well.
So what you're saying is going forward, we could see, a diminishing in revenue if we find the big users are adversely impacted.
Well,
And
one
I don't
of the
know what
things-
that is. I'm just saying, I don't know what the big users are getting hit for, whether it's 10% or 15% or 20%.
No, it depends on where you are in the consumption. Under the Public Service Commission, you're guaranteed a rate of return.
Right, I understood that. Yeah, I know that. Mhm.
So those would be the type of changes that would be made if we went to the Public Service Commission. But I understand that that's going to be a local bill and not a statewide bill, so we may be the only impacted utility.
Jim, do you know if that rate of return is greater than what we now have or less?
Well, using the electric, because I don't know about the water, what their rate of return is between 9 and 11%. We take 6. 6 is what we transfer back to our general fund.
Mr. Chairman, if I may ask, Jim, for clarification purposes, currently our rate structure, would you say it's fairly balanced between the homeowners, the single property owners, the businesses, as opposed to the county? That's one question. And as I heard the conversation evolve, if the businesses are paying less, that means that you said earlier there's going to be winners and losers. So that means that the individual homeowners might be paying more for the same gallon of water than a business would be paying. So I'm just wondering, across the board, when you look at it from the economic standpoint, when you look at it from the usage issue and from the conservation issue, how different is the county schedule and the city schedule?
Okay. From my standpoint, since we have an established utility rate structure that has been accepted, and I think people have lived with it and geared their lives around it and their businesses in the city of Vero Beach, I think it's a very fair rate structure for the city of Vero Beach. But what we're saying here is if you use a lower amount of gallonage in the city, your first 5,000 gallons, you're going to pay more per unit than you would under the county rate structure. But once you get, and our theory is that we base it on, I can serve you 5,000 gallons of water, and it's only a very small incremental cost to get you 10,000 gallons of water. The product that I'm serving you is a relatively inexpensive product. So my cost of service to you is actually setting the meter and serving you 5,000 gallons of water. The county's theory under their rate structure is that I'm going to serve you 5,000 gallons of water at this, but because you're going to use more, I've got to build additional capacity that you use more than your friend next door. So that additional capacity, I'm going to charge you for that. So that price per unit in the upper levels gets higher. And that, and the philosophy. But if you go to conservation as the issue, more than likely the county rate structure is a better conservation rate structure because it discourages uses in higher levels. The negative to that is if you don't raise, it's like Cindy and I've talked many times, your revenues have got to be better than your expenses or you're going to go out of business. So what happens is if you employ conservation and you have the resources to provide that, then your lower tier prices are going to go up anyway. But that's the issue that is there. But the county rates are really built around the theory that I've got to build capacity for you as a large one. In the electric business, we do the same thing. If you're in a business, you have a demand charge. your price per unit when you have that demand charge gets much greater than the people in a residential unit that has no demand charge.
I'd like to point out that the system for the city of Vero Beach is in fact dense and it's built out. So the opportunity for expansion and requires, putting aside the septic issue, but for the water delivery is very different than the county, because the county does have exposure in terms of potential major expansions, which indeed would then trigger those required additional capital costs for them to expand, as opposed to the city. So, to try to unravel this in terms philosophically of conservation versus return on investment versus capital versus regulation becomes difficult. But part of this stimulus, both from Indian River Shores, and of course Indian River Shores doesn't have major commercial entities, but from the residents' customers, particularly from South Beach and from the shores, were clamoring for getting the county rates. And so in response, as I understand it, to what the will of the people, this was one of the proposals that had come up and is going forward.
Don't discount our good users of irrigation water up in the Indian River Shores. We have a lot of them that are use potable water, and they have very large properties and have a lot of grass and a lot of vegetation. And so they are very good customers of ours in the water business.
Okay.
Coming,
You mentioned we have 2.5% of revenues with these new rates. If we did not change the rates, what are the other ramifications?
If we did not, there is no ramification. This is a unilateral decision because under our franchise agreement that runs till March of 2017, we don't really have to do anything. And there's a real question what we'd have to do in March of 2017 as well, because franchise agreements unilaterally or universally are more of a right to serve in the area and remit back to the governing body a franchise fee of up to 6%. And that's what historically these franchise fees have been. It just so happens that in our particular case, it's become a little more of a contract per se. But again, nothing happens, but we're trying to accommodate based on what the county has told us is that everyone wanted county rates, so we are trying to accommodate that, and we see that as not a negative impact on the city, so we could do it pretty easily. We've got our provider of our bills that we've worked out because we've already done Indian River Shores, so it's really just accommodating that same rate structure.
I think one of the comments was
Mrs. Barton, I'm sorry, is your microphone on?
It's on now. One of the comments mentioned that perhaps city users are paying a higher rate, than they would get with this changed county rate. Without the change, are city users still paying more than south?
It all depends on your consumption pattern. The consumption pattern dictates the differences between the two rates. Be very honest with you, if we went to county rates, I would be paying more because I irrigate my yard with potable water because I don't have reuse available. But if I was a family of three and I used 3,000 gallons of water, I'd be paying less.
So basically, Jim, what you said earlier, the person that gets up, they get ready, they take their showers, and they go to work. The other person that stays home, fills a swimming pool, waters his lawn, they are subsidizing him for that water usage.
That's correct. Yeah. The guy that has a swimming pool, we love swimming pools too.
I just want to point out that some of this impetus has been because the county has gone publicly to both Indian River Shores and to South Beach, talking to the fact that, in fact, they could provide county rates to those customers. And that, as I understand it, is part of the pushback from the particularly residents about getting county rates.
And we need to include, I mean, South Beach is one area, but we also have quite a few customers in and around the city that will also be impacted no matter how the franchise comes out and that kind of stuff. So I don't want to exclude them, and I know South Beach gets a lot of the press coverage, but the fact of the matter is there are other people that will be impacted.
Well, and the large businesses which are on
coming-
the mainland.
Yeah, coming back to that though, Jim, have we done pro formas for some of our big water users that show the impact on those guys? I mean, does the hospital know the impact and have?
No, sir, we have not, because we've been responding to the county. I'm not sure that it's in our purview, but you know, if the hospital says I don't want it, I can't readjust the rates for them. And so I think and we use the county commission as the representative of those customers because they are the representative. It's sort of like Indian River Shores when we had that discussion up there. We used the city council as the governing body. We did not do any impact on different customers.
That's a little more of a homogeneous base, though. I mean, I understand that, and I understand there's political push from the homeowners, and we can make a reasonable case for a homogeneous base, but the reality is the employment center in this city is very limited. And the question is, how adversely are we affecting them? I have no idea.
I think that would come under one of the requirements of the county. I mean, again, that's where the push is. We could stay with either rate structure. We have no problem staying where we are. But, you know, when I keep reading in some of the publications that we're 20% higher and all this other stuff, I'm only responding. And I, you know, the county administrator and I just met last Friday, and the mayor was there along with the chairman of the county commission. And he confirmed the fact that they had done the flow studies of the hospital, and they are going to be a major impact. But that's an entity of the county, and
well, it's an issue of the county, but it's also an issue of the city from an employment point of long-term growth potential of the city too. So I understand what you're saying. Yeah. We can duck our responsibility and say, well, they're going to take care of it. But the reality is, we're all in the basket together. And I, for one, have never seen that type of comparison. I don't know what the impact on our major employers are.
Well, you know, Jim, from my perspective, I understand the conversation here. Our important issue is to take care of the city's finances and welfare. And however best that works in our city and doesn't punish our customers seems to be the most reasonable. Any business that has increased cost, whether it's in production of goods, cost of raw materials, or whatever, they're going to accommodate their end of it from that perspective. I think what we need to do is look at how is this going to affect our budget in the city and provide the services that best meet the needs of the majority of our customers. And that's not to say we just discount everything we've talked about here today. But certainly, I think that's our first objective, is to make sure that we have a budget that we can substantiate and that the longevity of the city is taken care of.
And that's exactly what we've done. That was the whole reason behind this decision making. If it would have skewed, then we would have had a lot more discussion. If, in fact, the 20% number that people used at one time was an actual number, we wouldn't be here in front of you recommending that we go to county rates. As a matter of fact, the discussion would probably turn to some other format. But again, on the customers themselves, Glenn, we've got to deal with the governing board who is representing those folks. And again, the county administration and at least one of the county commissioners obviously knows there's going to be a negative impact in that area. They understand their rate structures and how they work as well. But from our standpoint, we're responding to the representative and have no way of going around to, what do we have, 3,000, 7,000 customers outside? And going around and making a profile for all of those folks. And again, from the city standpoint, we'll hold status quo or however they want to do it. But again, we're responding to what the demand is. And you got a demand of a group, not individual customers.
Mm-hmm.
Answer any other questions you may have for stir any more pots that you want to.
Well, I appreciate the discussion. I think it illuminated some points that perhaps haven't been brought out in other venues in terms of providing information that the public may be
And I do
interested
think
in.
it's important. Don't get me wrong. I'm not saying, I turn a blind eye to the hospital. That's the reason I brought it out, was because people need to understand that we're shifting a cost here is what we're doing in essence. And we're doing it under just two different rate structures. And I was asked if I think our rate structure is fair. The answer is yes, I do, because for 30 years, people have designed their lives and their businesses around our rate structure. And when you make that dramatic change, then it impacts, and that's going to be an impact on folks.
I thought it was interesting, too. You said it's a sort of a unilateral decision. I mean, it's not as if our city people are pushing for this, and it's not as if the hospital is pushing for this. I mean, we've got a very vocal, small group pushing for the situation.
5 of them are elected people.
I know. right.
Exactly.
Yeah.
Staying ready for any other questions you may have.
Your comment about being a lawyer on TV, we have one here, and now you are on TV, so perhaps you're qualified. Rob, do you have any comments? Now, I just found there is, when you get into the guts of the fees, our family has some property in the county, and this came up about a year ago, is that if there is an accessible sewer line in front of your property, even if it is not connected in the county structure, you pay a fee, correct? And that was some controversy before the council about a year and a half ago.
Yeah, if you paid the impact fees to the county, then you would pay for that piece of property. In other words, you reserved capacity at that point, and then you became a payer of a base fee. Where in the city, if you don't have a structure, you don't have anything, it's a vacant lot, you don't pay anything.
So that's why when you're trying to say what is the exact amount with some of the, there's a whole laundry list of fees other than just the water capacity and so forth. But thank you. Go ahead.
Yeah, and the other fees that we were talking about relate back to impact fees, certain things along that line that you did a study based on what your needs were for the infrastructure. By law, there's a formula that you go through to determine what an impact fee is. We can't adopt their impact fee structure because it doesn't apply to our system. So therefore, when we said other fees and charges, those things that we followed the law and that we established, we have to keep those in place. Also, when we looked at integrating things as far as lake connections or reconnections or other those miscellaneous charges, because we established them and we have certain things and we run an electric business also, we weren't going to go changing all those fees that were kind of driven also by the electric side to impose just on the water and sewer. It would become too complicated.
Questions? Thank you very much.
Yeah, in the public service, when they consider what the rate of return that allowable is, when you said as high as maybe 11%, do they also have benchmarks for expenses? Or
Yes, when if you come under the Public Service Commission, there are just unbelievable amount of issues and parameters that are set. For example, under the Public Service Commission, if you're going to do a capital investment, and I'm using electric because that's who I really know better than water and sewer. If you do a capital project, you've got to get that approved through the Public Service Commission because you're getting a rate of return on that project. You've got to go and justify the capacities needed and all these other things that you would do. And so on that capital project, that goes into your rate base plus your return. And if you do excessive maintenance, as an example, and they declare it excessive, i.e. you're fixing new pipes with new pipes, then they will hold that out of your rate base and require you to make that up in some other form or fashion. So and it's all those components. So you make these reports to the Public Service Commission that shows your business activity and what you're doing, and then they review your rates, your rate structure to make sure that your classes of customers are treated the same and all these other.
I think you answered the question I was probably getting at, is that we had a lower rate of return, and I didn't know if that was because our expenses were higher or, our actual rates were lower. But you're saying we have to stay within certain guidelines on the expenses, so.
That is correct.
Or they would take it out of the structure.
Exactly. And our 6% is really a dictate set by the city council that's all we can transfer into our general fund. So that's where that came. And when Cindy and I first came here, we sort of helped establish that with the city council because we thought that was a fair number, as opposed to it used to fluctuate all over the board depending on what the needs of that particular year were, and typically came out of electric more than it did water and sewer.
I just wanted to make a comment. When you're talking about the PSC and rates of return, it's great, except municipalities don't pay any taxes, and private industry does. So when one talks about structures, it's a bit more complicated than just saying what a rate of return is straight out, just as a comment.
And it would be a new experience, I think, for the Public Service Commission of this theory.
Yeah, sure would.
I don't. Well, I'll reserve comment on that. But all right. Old business. Yes, ma'am.
The first thing we want to talk about today is the quarterly financial reports. I know some of you were here when we were doing the monthly, and probably toward the end of last fiscal year, we all agreed that we would do these on a quarterly basis instead. And one of the things that I said at that time is I'd like to start adding some things to these quarterly finance reports that were a little above and beyond just the line item expenditures and revenues that we've had in there in the past. So what I'd like to do for a minute is look at the 3 things that I've added to these quarterly reports and get some feedback from you as to whether you think they're useful and whether there's other things that are not in here that you'd like to see. So hopefully, the other comment I wanted to make was I think we agreed 5 or 6 months ago that we'd send these out to you electronically. Now that you've had a chance to do it that way, if that's not working for you and you'd really prefer to have a hard copy to make notes in or tag or whatever, please just let me know and I'll make sure that I get you a hard copy of this as well. Okay. The quarterly report that looks like this if it's bound. The first thing I wanted to look at is actually on page 8, if you can find that. And this is the first thing that we've added. Excuse me, I have a frog in my throat. It looks like this, and what we've added is a schedule showing the pooled cash and investments balance by fund as of the end of the quarter. And what this does is show you in a consolidated way how much of the city's pooled cash and pooled investments, and by this I mean the short-term cash type investments, not, and there's a note at the bottom, this absolutely excludes our investments in pension trust funds. This is actually our working cash and investments. How much of the total that we have of about $63.6 million belongs, if you will, to each of the individual funds. And so I thought that might be useful, particularly because you'll see it kind of wax and wane as we go through the year. For instance, right now the general fund, which is the one right at the top, at the December 31st has about $10 million. Well, that's $2 or $3 million higher than what our typical year-end fund balance is. And the reason for that is that we take in almost all of our ad valorem tax revenue in the first quarter of the year. And so we'll go through the rest of the year without much more ad valorem taxes. And over the year, that cash will slowly wane down until you see it at September 30th at a number that's pretty equivalent to our typical year-end fund balances. The cash flows in all of these funds, well, not all of them, but in most of the big ones, are absolutely not linear, and you've seen that by looking at the quarterly variance analysis where there are just so many important revenues and expenditures that aren't pro rata. And so I'm hoping that this page is useful and will be useful when you start looking at it year over year to see how our cash flows in across those 4 quarters for each of these funds. So that is the first thing that we added. The second thing that I added is something that I think you've seen before, but I'd like to go ahead and included in the quarterly reports because I think it helps to clarify the conversation we always have about how our system in the enterprise funds shows only the interest payments on debt and not the principal payments because of the way we account for enterprise funds. So this schedule here on page 9 is actually a summary, and I'll do it each quarter, of the city's debt for all of the city funds. At the top, you have the governmental funds debt that's supported by the general fund and the 1 cent sales tax fund. And what you have on this page are the name of the loan, the interest rate, the maturity date is the year in which we'll have it paid off. Then you see.
Cindy, I apologize,
Sure.
and I'm sorry for interrupting, but I may not have printed that section out. Do you have an extra copy?
I do
of
have an
that?
extra copy. But only one extra copy. I'm only a little bit of it. And that was page 9 on that. In the center section, what you see is the principal balance we started the fiscal year with. In that center column here, any principal payments that we've made year to date, and then what our current principal balance is as of the end of the quarter. And in the far right column, you can see the interest payments that we've made year to date. And again, each quarter we'll update this. The best way to look at this, and I think most of you have it, if you have a copy of the CAFR, is if you open that CAFR to the notes section, there's actually a fairly extensive note in the CAFR that talks about each one of these loans. It explains what the money was borrowed for. It tells you what the interest and principal payment dates are, what the starting balance or the ending balance was, which matches up here in the principal amount, and shows you in that note a schedule for the remaining interest payments across the life of the loan. So this is something that I'll update quarterly, but and we can do this after the meeting if you'd like, I'll show you the part of the CAFR that's a really excellent companion to this particular schedule. I think this schedule helps a little bit too when you look again at the cash balances for the funds and, for instance, the enterprise funds. If you look at the electric utility and you look at the principal payments that we've made in the first quarter, we make both of our big principal payments on December 1st every year in the electric utility to the tune of almost $5 million. So as a result, our cash at the end of the first quarter is always going to go down by more than a pro rata amount because that $5 million, actually it's almost $7 million by the time you put in the principal, goes out in the very first quarter, and we don't make debt service payments again the rest of the year except a very small amount. So I think that really helps. This helps hand in hand with the cash balances. The last thing new thing that we put in here is actually all the way back on page 26. And it's right at the end of the electric utility section. And it looks like this. And what I've prepared is a consolidated balance sheet, a very simplified one, for the electric utility as of the end of the first quarter. And that's on page 26 in the report. And so what you can see, again, at a very high level, are the assets, both the unrestricted cash and investments and the restricted cash and investments, our receivables, and those are net of uncollectible allowances, our inventories, and our capital assets net of depreciation, our liabilities, which include any accounts payable we have, our compensated absences, which is a big one, our customer deposits, and then our total of short and long-term bonds and notes payable plus the accrued interest. And then at the bottom, our net assets are broken out into what we have invested in capital, net of the related debt and depreciation, what we have restricted for emergencies per our bond covenants, which is $2 million. That number won't change, and what our unrestricted net assets look like. What I've also done at the bottom of this, because we've had a lot of conversation, and we did last time when we looked at the rate sufficiency, have conversation about our days of unrestricted cash, is, and I'll do this quarterly, is look at where our total cash balance stands at the end of the quarter and how many days of unrestricted cash we have on hand, which comes from this number up top, the 15 million. And what you can see is at the end of the first quarter, that actually is down to about 72 from the 76 or so we were looking at earlier. Again, I don't consider that alarming because we paid almost $7 million in debt service in the first quarter, and that won't happen again in any other quarter between now and the end of the year. So,
Cindy, question, please.
Sure.
Unrestricted cash, does that cash on hand, is it part of your reserve fund? Is it part of your fund balance? Is it?
Actually, if you look at the top, that's an excellent question. Let's take it from the direction. The restricted cash is equal to the customer deposits, because we can't spend those, as well as the short-term loans and notes payable, because we run a sinking fund, as well as the $2 million that we have to hold in reserve for emergencies per our bond covenants.
So there is a trust fund involved in those restricted.
The restricted is $2 million for the bond covenants from the bottom. It is $4.7 million in customer deposits, and it's the amount of money that's in our sinking fund at that point in time.
Oh, that's cash in hand.
And that's actual cash, but that's cash that we can't spend.
Right.
And so that's why I've segregated it from the unrestricted cash, and that unrestricted cash is what we use for the calculation of how many days we have on hand. For instance, and the easy one is the customer deposits. We have almost $5 million in cash in customer deposits, but we can't spend it because it doesn't belong to us.
Okay. Cynthia, on that 72 days of unrestricted cash on hand, does that appear for the city to be about average? Is it some days a little bit shorter than that? And some periods a little bit shorter and other times?
Our target is 90, and we were up around the 90 mark, and we had an extensive conversation about this when we talked about the rate sufficiency. We were up around the 90 mark last year, and then we came in a little bit under where we wanted to be for 12-13 in terms of rate sufficiency, so that took it down a bit. Between our budget for this year, our rate sufficiency, and a couple of other things that are going to happen, we believe we'll be back up a little closer to the 90 mark by the end of the year. But 90 is what we'd like to see. That's sort of a minimum from both the recommendation of the GFOA as well as bond rating agencies in terms of what they like to see for liquidity and cash on hand.
Cindy, one other question while we're on that topic. In that unrestricted cash of 72 days, does that include any salaries and benefits that would have accrued? That I'm not sure when you have your cutoff, but obviously if you have it at the end of 1 month and you do this the next month, you've already incurred some salaries, benefits, those types of expenses.
We the unrestricted cash on hand, the calculation of the days of unrestricted cash on hand, and that's an excellent question, is fairly straightforward. If you look at the operating expenditures minus depreciation, those are the budgeted operating expenditures less depreciation, and you divide that by 365, because we're a 365, round concern, and you take that number and divide it into unrestricted cash on hand, that's how you'll get 72. It's not on an accrual basis. It's on what are our operating expenditures for the whole year, what's our daily average, and how does that look when you divide it into unrestricted cash on hand.
So there could be some salaries and benefits that may not show under the 72 days. So,
and we do enterprise funds on a full accrual basis, but most of the accruals that we run all year long on essentially a cash basis, and most of the accruals take place at September 30th for the closing of the books. So, for instance, there is some accrual portion in the actual expenditures because we do take that first payroll of October and reverse the parts that belong in the prior year, but we don't every single month. We don't do accruals every month.
I understand. Yeah. Okay, thank you.
Cindy, on page 8, your pooled cash and investments, you have a self-insurance trust under risk management of $3 million too. What items are self-insured?
We actually, as a city, were self-insured for everything. Liability, auto liability, workers' comp for a number of years. And starting with the beginning of last fiscal year, October 1st, 2013, we were fully insured for everything. And so the self-insurance trust as it stands right now is actually winding down, and what we're doing is a run out of the claims that existed before we became fully insured. That's kind of a major move that we made over the last couple of years for both self-insurance and also health insurance. So we do have a fair number of outstanding claims, including one fairly large reserve in the self-insurance trust, more than adequate cash to handle the runout, and it's my hope that those claims will be resolved or get very small within the next year or so, and then what we would do is take that residual amount and figure out which funds it belongs to, because essentially that self-insurance trust was an insurance company. Each fund made contributions for many, many years, and claims were paid, and then have a return of premium, if you will, back to the funds that it belongs to. But it's probably going to be another couple of years. We've got a couple of kind of complicated claims that we're still running out.
So I wondered, I thought we were fully insured now, and I didn't realize there were outstanding claims.
There are a handful in GL, auto, and workers' comp, all three that, and then one fairly large one that's about 5 or 6 years old. But the reserves have gone down substantially. When you see the CAFR, we actually, for the close of fiscal 12-13, did a close out of the fund. In other words, that was our place where we drew the line and said, okay, now we're done. Everything going forward belongs in the individual funds, and we have our arms around exactly the claims that exist and what the reserves are for them. So when you see this year's CAFR, the claims reserve will have gone way, way down, and probably in a couple of years we'll be able to close that fund out entirely.
And on that same page, Cindy, can you explain the return premium assistance, what that is?
I keep losing that page.
That's
a popular page. I will not close the book again. That's a cash clearing fund. What that is for our health insurance premiums. What we do is, instead of running the retiree health insurance premiums through the other health insurance clearing fund, we run them through here. So you'll see that go up and down a little bit depending on the timing of us paying versus the collecting the money from retirees versus as they go in and out. That really is just a place where it's a clearinghouse fund.
Okay, and then it seems like all the funds there are positive, with the exception of two, the Marina and the Cresslawn Cemetery Fund. Do you know why those are?
The Marina has the situation, and that's kind of why I put these two pages together, of it pays its entire debt service payment for the year in the first quarter. And so our pro forma for the annual Marina budget, and they're doing pretty well, budget to actual, is that by the end of the year they'll be back in a place where that's not a negative number, but they always take a beating in the first quarter. As far as the cemetery goes, that's been a topic of much discussion, and that is a deficit that we know has been there for a number of years, and actually it has improved over the last few years. And our goal is, I think based on the rate structure we recently adopted, should turn that around to a positive number by 2-3 fiscal years from now. We're climbing out of that hole.
I just have just an observation, and I know we haven't borrowed directly for the electric fund back to the 80s or what. However, the interest rates are over 4% for the electric fund, which is about double all of the other funds' borrowing rates. And I recognize that one of the loans defeases in 2016. The other one defeases in 2021. It just seemed to me that we couldn't refinance them, or
we at Craig Dunlap, our financial advisor, has been extremely proactive in identifying the opportunities for refinancing. If you see the top of this page, Series 2012A and 2012B, for instance, were both refinances from last year that lowered our interest rates down to just over 1%. In the case of the ones in the electric utility, there are prepayment penalties and dates before which we can't actually call the loan without paying a prepayment penalty that essentially makes the bank whole for the lost interest, so it's sort of a waste of time. In the case of the Series 2008, I believe, again, it's a timing issue, and certainly one relative to the sale of the electric utility. So we examine these periodically. Craig has been really good about identifying those opportunities, and we'll keep doing that as we can, but with some of the prepayment penalties and dates, it doesn't. You don't win. By the time you pay the penalty, you don't save the money. So, I guess the question I was going to ask has sort of been answered in that: do you find these three things useful? Because they seem to have sparked a lot of conversation. And if you can think of other things that we can add, just as a enhancement to these reports, I'm happy to do that.
How can debt be added? Only through bond issues, or? How do
Only through bond issues at this point. Well, we say bonds, but typically what we've done recently are just bank qualified loans. We haven't borrowed anything in excess of 10 million, 11 million in quite some time. But we don't have any lines of credit or letters of credit where we can just go out and add to the debt. We have to actually do RFPs or get state revolving fund loans and bring those loans to the council for approval. That's the only way we can add debt.
Excuse me, Cindy, I was going to ask you, in the event that 72, 90 day, if there is a hiccup along the way, you do have legal capabilities of making a short-term note, correct, in order to maintain operation?
Yes, we actually have. If you look at our CAFR, our debt service coverage is well above what is required by our various bonds. So if we were in a place where we had to borrow, I think we have some coverage for it. But I'm thinking we'll be back up in a place where we need to be pretty soon.
Yeah, I'll underscore that this is very helpful, because in the past, essentially, folks just looked at the budget, and that was without melding in all of the other consequences and impacts of cash on hands and the funds and the timing of the payments and what that does to going forward.
Good. I'm glad. I think I tried to design at least these 3 pages for the questions I seem to get asked the most, and I think it also, I agree with you, helps you focus on kind of the big picture. Instead of us getting lost in all these line items, what are the realities of the city's fund balances, cash flow, financial position with regard to stability and liquidity, and I thought these might be helpful. So I can expand on it, and we'll maybe try to add some new things for the next quarter. How's that? And the quarterly reports, if you have any specific questions, but as is usually the case with the first quarter, not much exciting. The good news is, for the first time in ages, you do not see return on investments on the quarterly variance report, because we're doing a little better this year than we have in the past year or so. So that's first time they haven't been on there.
Well, I know we did. You had done the first rate sufficiency for the first quarter.
Mm-hmm.
One of the things I did notice is that in the transactional attorneys, which are budgeted for $1.2 million for the year, are running at a rate of $15,000 a month, and so it would seem to me that the fact that until we can get into more robust negotiations with the attorneys, that could potentially have a positive impact by not spending the $90,000 per month, which is $1.2 million divided by 12.
Yeah, that could definitely be helpful. Certainly year before last, we under budgeted that line item and ended up having a budget amendment that went the other direction. So for this fiscal year, we budgeted about $1 million based on the average run rate from the year before. And with where the negotiations stand, you make a good point. They're way behind that at this point. So yeah, that could be helpful at year end too. That could make a positive variance and help our cash.
Yeah, and I also looked at the 2 months power cost, which seemed to be running at a rather low rate in terms of for the 2 months.
The two out of the 3 are a little lower than they should be for the 2 months. Remember, it's 2 months and not 3.
Yeah.
But again, that was all incorporated in the rate sufficiency as well. So I think where we leapfrogged a little and where it'll catch up next quarter is that you looked at the first quarter electric utility rate sufficiency like 3 weeks ago. And what I plan to do going forward is bring that to you as part of the quarterly review package. And then we'll put those 2 things back together and we can look at them side by side. So
we will, presumably that would be in the April timeframe.
First week of May, I think, is what you decided you would do for meetings. Next meeting, the first week of May.
Yeah, and as we had discussed in our annual report, that we would have the 4 regularly scheduled meetings quarterly, and with an ad hoc or special call if the city council or the mayor wants to have some interim input from the commission.
Correct.
Questions? Cindy, this is one of the items that we had talked again in the annual report as one of our goals, and one of your goals, actually, to have a discussion regarding streamlining the operations for customer service.
Yes, this is a topic I'm a little bit excited about because we've been working on it for about 3 or 4 months internally. And I want the chance to, this truly is a discussion, to discuss it and bounce some ideas and concepts off of you and get your feedback before I come back with a formal report and a recommendation through you to the City Council. My implementation target for some of these ideas is to start like July of this year and have almost all of it in place by December 31st. I don't think you remember last budget season, we had talked about eliminating the cashier window entirely, closing it. And at that time, the answer was no, don't do that, but come back in 6 months with a plan for how you might restructure that function for some efficiencies and some cost savings. And so what we did was we had Wells Fargo, who's our bank, come in and do what they call a business process review, meaning that they actually came and did a ride-along, if you will, for a couple of days in our cashier area with our IT people and looking at our daily processes. They went and they digested all that, and they came back to us with some recommendations for technology that they thought would improve our cashiering function. And then in addition to that, myself, my customer service manager, and my cashier supervisor have spent some time in the last few months coming up with some ideas that build on that we think is really going to improve the function. If I could, let's talk about each one of these things. I've given you a piece of paper that shows monthly volume of types of transactions. I think I put one up there. Does everyone have one? Types of transactions and the average monthly volume. And so as we talk about what I'm proposing to do, it'll impact each one of these pieces of the function in the cashiering, and just talk a little bit about what we're planning on. Right now, my current staffing for the cashier function is 3 full-timers and 3 part-timers, 6 total people. It's about $122,000 a year, plus benefits and the operating costs. And a good portion of that gets charged to the electric utility and the water sewer utility, because a big part of the cashiering function revolves around the utility bills. But it's important to keep in mind, not all of it. The cashiers are also the accounts receivable location for all of the funds that come into the city in cash and checks. So it's not just the utility bills, although that volume is very high, and that's all we'll really be talking about today. It's also the money that comes for fines from the police, the money that comes in through the planning department, the money that the city clerk takes in for the purchase of cemetery plots, the recreation revenue. They are the central point of collection for all of the city's cash and check revenues. So the function can't ever go away completely, even if we didn't have any utilities. However, we believe there's some real opportunities to improve it, and I'd like to just talk about those. If you look at this sheet, one of the first things, let's talk about the second item here, hand key mail, about 6,500 pieces a month. What that is right now, about 95% of it anyway, when you go on to your bank, let's say you're a Bank of America customer, and you go do an online bill pay of your city utility account. In your mind, you think, okay, I've done that online bill pay, and some electronic payment goes to the city of Vero Beach. What really happens is your bank creates a paper check and mails it to us. And 95% of these 6,500 checks a month are paper checks generated by online bill pays. And let me tell you, they are worse than regular checks because they don't come with the coupon, with the OCR coupon. They can't be scanned. They don't have account numbers on them in many cases. And they're hugely labor intensive for the cashiering staff to identify the right account to apply them to and to actually hand key them into the system. Okay? And 95% of that 6,500 is that case. So the first thing that Wells Fargo suggested we do, the easiest thing, is to implement a system called e-box. And essentially that would replace all of these paper printed checks with an electronic capture of the online bill payments bank to bank. So instead of getting these paper checks, we would get a daily file from Wells Fargo equivalent to an ACH or EFT file that we would import right into our billing system and eliminate 95% of those. And that one is a real no-brainer. Again, I want to talk concepts and not numbers. We'll talk a little bit about the dollars at the end, but that's a huge no-brainer for us. I think we could come into well, maybe not this century, but at least the last century by doing that. And I'm just going to pause after each one in case anyone has any questions or comments about that particular function, if you have experience with it. The next thing, which is 5% of that hand key mail, and the whole 12,000 scannable mail pieces, are the bills that come in envelopes. They come typically, hopefully, with the OCR coupons so that we can scan them, or they come without them, but they're regular checks with people's account numbers written on them, and that's the other 5% of the hand keys. And as you can see, that's a huge, huge volume of what we get every month. What Wells Fargo is proposing to do for us is what's called a wholesale or a wholesale lockbox. Essentially what they would have is a virtual P.O. box. We would change all our bills to that P.O. box number, and all of these mailed bills would go to Wells Fargo. They would process them. They would again deliver to us an electronic file for a capture of the revenue into our utility billing system. And the only thing that we would do is clear exceptions through an online web portal that we've already tested. When I say exceptions, let's say they get one and it doesn't have the scannable coupon and it has an account number written on it that happens to be 14 digits when we know our account numbers are only 10. They have a way for my cashier supervisor and my staff in cashiering to go in daily through a process onto an online portal, identify and clear those exceptions so that the whole batch can be processed. The clearing of exceptions is something we do anyway. We get that stuff all the time ourselves. The advantage here is that this would eliminate the rest of the hand key and all of the scannable mail from flowing through the city's cashier function. The next thing is down toward the bottom, you see CSI credit. We have about 1,000 people a month that pay through a company that we pay. You can call on the phone, or you can do it through their online portal, and you can pay your bill by credit card. Right now, the fee, if you do it over the phone, and you can only do that from 8 to 5, is 2.95% of your bill plus $2.50. And if you go through their online portal, it's 2.95% of your bill. If we implement the lockbox, we have the opportunity to do away with most of that by changing the bill coupons and putting in a spot where the consumer can write in, just like you do with a medical bill that you've seen, write in your credit card number and the expiration date, and Wells Fargo will process those credit card payments with the lockbox mail. And at the same time, we can add a credit card machine to our cashier window. And between those two things, customers would have the option of either just writing that credit card number right on the scannable OCR and we'd get that through the lockbox, or they could come to our window, take out their credit card, and pay. People would still have the opportunity to do this with CSI if they wanted, but we could capture the fees. And, again, we've had the whole credit card fees discussion. We're not allowed to charge more than, et cetera. But we would capture some of the fees and more importantly, would provide, I think, another easy way for our customers to pay their bills, because we do have at least a fair number of people that do it by credit card anyway, even though it's as expensive as it is. And I think if it were easier, we'd probably have quite a few more people that would pay by credit card if they could do so in the lobby or just with the submittal of their bill. EFTs, we do have, in my opinion, a frighteningly small number of people that take advantage of just automatic payment draft from their bank every month, about 5,800 people. That's a little thing, but I have seen utilities that incentivize people to use EFT by, for instance, waiving all or part of a security deposit when you show up to sign up for an account, which is easy to do if you've got an EFT going and you're going to actually know you're going to get your money on a timely basis every month. So we're going to look into, Wells Fargo can't really help us with this, but we're going to look into seeing if we can't get people more excited about this EFT thing, which saves a lot of processing. Now, the last thing that we have then are the combination of the walk into the lobby, drive through the lobby, and use the night drop customers. And if you look, we're talking about 7,300 through the lobbies, about 1,700 more at the night drop. Right now, our lobby hours are 8:30 to 5, Monday through Friday. If you get through that door before 5 o'clock, we will stay until we have taken care of everyone in the line. Our drive-through hours are 8:30 to 4:45 p.m., and if you're in that line before we pull the chain behind you, we will take care of you. And the thing that's astonishing about that is the way we handle cutoffs. If you pay by 5 o'clock, I mean, if you come in there at 5 minutes of 5 and you pay your bill, you can get yourself removed from the cutoff list for the next day, for the cutoffs that begin at 7 a.m. The customer service works the list. They stay after 5 to verify those last payments that slip through the door. They call CSI to capture the payments that people have called in on the phone by credit card. And then they transmit that list to the electric meter shop, and they begin cutoffs at 7 a.m., and you can get yourself off that list at 5 minutes of 5, 2 minutes of 5, if you can slip through the door. The cutoff is around, the list is normally about 20 to 80 people a day, and of that, we estimate maybe 30 of those people come in and make it off that list at the very last minute, at the very end. Okay, so we're talking about maybe 600 people a month out of that 7,000 that are availing themselves of that, what I consider astounding customer service, to be able to come in at 5 minutes of 5 and not be cut off on the following morning. In order to realize some cost savings and some staff savings from doing all these other great things, from getting rid of 12,000 scannable mails and 6,500 hand keys and credit cards and all the rest of it, we're still going to have to make some adjustments to the lobby hours and the drive-through window. And the reason for that is, the bottom line is, no matter how much you reduce the volume that has to be processed, if you have an open window, there has to be a person sitting in it. Okay. Right now we have 2 customer service windows in the lobby, 2 lanes in the drive-through. So we could do away with what amounts to, percentage-wise, 80% of the processing that takes place in that cashier cage. And if we've got an open window, there has to be a person sitting in it, which means X amount of people for X number of hours a week. And so the point we've come to is, we're not going to be able to realize the savings or the efficiencies or any net dollar savings without also modifying those hours slightly. Obviously, still with an eye toward excellent customer service, but certainly, if we backed up that cutoff time till 3 o'clock and closed the lobby at 3, or opened it a little later and left it open till 4, we could achieve some real savings. And I don't think that, honestly, we'd be impacting that many people, particularly if we made sure we didn't just show up one day and change the hours, but that we undertook a process to educate people and to make sure that they knew that, starting a month and a half from now, you can come in at 5 minutes of 4 and get that taken care of, or 5 minutes of 3, but you can't come in at 5 minutes of 5. And so when we bring you the numbers and the final recommendation, it will include some modification of the drive-through in the lobby, because, in our opinion, that's really the only way to achieve some real savings. We're going to make a couple of other real small improvements in a now time frame. We're going to come up with a take a number system for the people waiting for customer service representatives. We have lots of line jumpers, and it makes people come up and sit down already mad before they even get started with their problem. We've got some chairs in the lobby. People sit down to take a little rest, or because they can't stand the whole time, and lo and behold, now they've been waiting and they can't get to the window fast enough. And we're going to get some of those great movie theater velvet ropes for the cashier windows, because it had been a couple of days in the last few weeks where there's so many people crammed in the lobby, there's absolutely no order to the line. And I guess bottom line, what I'd like to do is just recap, if I could, what I think are some of the benefits of the concepts that we've laid out here. First of all, reliability. We have had a hard time finding and retaining qualified cashiers. Retaining because the 3 of them are part-timers and they want full-time employment. And so when that opportunity presents itself, either within the city or outside the city, they move on. The benefit of that lockbox is that Wells Fargo is always there. They're not going to have a vacation day. They're not going to be gone. Every day, regardless of the ebb and flow of staffing, those utility bills will get processed. They'll also be, I think, with all of these things, a vastly improved service for the vast majority of our customers. There'll be more ways to pay, easier ways to pay. It'll be faster. We will have a quicker deposit capture for revenues, so the money will get into the bank more quickly, and if we ever start earning any reasonable rates on things again, that will be helpful. And there's also, to my mind, some other kind of intangible benefits, and I'm going to have a hard time putting a dollar value on. It will improve internal controls. Again, that puts a lot of the responsibility for the controls back on the bank. The more employees that you don't have, you reduce pension liabilities, compensated absences liabilities, other employment-related liabilities and issues like workers' comp. And also, lastly, it's going to affect the other departments' productivity, too. Right now, we have a situation where customer service and IT have both, over the last 6 months or so, had to chip in and actually prep bills for scanning, open envelopes, get hand scans ready, as we've had turnover within the cashiering department, and that takes time away from their limited staff and their productivity. And then the mail delivery. We have a warehouse person that does mail. I mean, there's 20,000 pieces of mail a month that are not going to come out of our PO box, come over to City Hall, and have to be sorted and delivered to the cashiering staff. So my plan is to put some dollars on all this. Obviously, there's one-time costs for some implementation in IT. There are monthly fees from Wells Fargo. Offset those against the staff savings and some of the other tangible and intangible benefits, and actually bring a proposal back that you can look at, and that we can then take to City Council, get their approval, and try to have this in place with an impact on next budget year. So
These sound like excellent changes and big improvements. I do want to ask one question about the walk-in and the drive-through. That's where you have to have a live cashier. Mm-hmm. Couldn't everything be a drop-off and not, the way you're using the night box?
Excellent question. What we predict is if we do, for instance, maybe close the drive-through and change the hours in the lobby, obviously the night drop volume will go up a little bit. But again, we can handle that within the people that are in there. If you look right now at that 7,300 people and the number of windows we have, it actually equates to about a person on average every 5 minutes. Now, not every transaction takes 5 minutes, but you have to be there because 3 minutes from then something else is. And right now they're putting all the rest of that work in bits and pieces between customers. But even if all of that work goes away, they have to actually be physically available to man that station for a customer. So, but yes, we would still continue to utilize the night drop. So anybody that didn't want to come inside, the night drop cutoff is posted pretty clearly right now, and you can still drop it in there and have it posted by the following morning without even coming inside.
I mean, that's why I wondered if you did away with the option of walking in or driving through, and you just put it in the drop box.
The other thing, though, about the option of walking, and we looked at this when we talked about eliminating it entirely, is one, we do have, outside the people that have to come in and pay at the last minute, we do have a fair number of people that like that convenience. But more importantly, we have a big high wall of separation between customer service and cashiering when it comes to receiving funds. And so the customer service personnel cannot take cash or checks. They cannot go in and post payments against bills. But what they also can't do is take money from people for new accounts. And so if we did away with the cashier window, people wouldn't be able to come in and open an account and pay with cash or any of those things. We'd have to find another entire way around that. And so closing it entirely, we've talked about it. It was not well received, for one thing, and it also creates another internal control problem.
I'd like to make a comment, two of them. With the current number of customers, and of course when hopefully we sell the electric, there is going to be a substantial number who are going to fall out. But secondly, of the 34,000 transactions, over 25% actually physically come to this location.
Mr. Chairman, one of the reasons, and if you go down there on a Monday morning as an example, you'll see people lined up at the door before we even unlock the door, and especially if it's right after the first of the month. The second thing is we have a lot of seniors, and this is sort of a visiting spot, and you can drop down there, and our cashiers know the people standing in line. They'll talk about anything and everything that comes to mind, and it's almost a social type of thing. But as Cindy says, we don't want to eliminate the total interaction, number one, but the other thing is that they do provide a very valuable service in listening to customers' problems and trying to resolve those when they come down there as well. And when we do when we sell the electric, a big number of that hopefully will drop off, but you'll be surprised how many people have water and sewer issues that'll still be with us. So, but it provides a multi-function. But when Cindy and I talked about these changes, and I agree that they are very good. I think they're going to help us. We might be able to narrow our window, but still give that opportunity to come in. And I think that's the key to success, where we can reduce man hours, which is the ultimate goal.
And even if we and back on the electric utility comment, and I'd forgotten, that's another reason in my mind that the lockbox thing is great, because it's not volume dependent. And so if once we sell the electric utility, they'll keep on processing in that lockbox. They'll just process at a reduced number of pieces and charge us what they've told us is this, it's the same rate or maybe adjust it slightly. So again, that will be a very seamless transition at the sale of the electric utility, as opposed to having 6 people and the next day not needing 6 people and having to restructure at that point in time.
Well, and the other thing is with this, all of this hand keying and the fact that you can use technology, you're not going to have the exposure to errors, to miskeying information and so forth. So,
well, at least it'll be Wells Fargo's exposure.
Yeah,
it'll be Wells Fargo's exposure. Ours,
Cindy, let me ask you just a quick question regarding the conversation we were having about the lobby and the drive-through and the night drop. In the drive-through, majority, the largest percentage, I'm assuming, would be dropping off checks as opposed to cash. Do you have much cash coming through those drive-throughs?
We actually have a fair amount of cash coming through in total, and it's something that costs us money because we get charged for making those kinds of cash deposits, which is one of the reasons I think the credit card machines would be great. The other thing about putting credit card payment options in is we would not be able to take credit cards at the drive-through, which would stack the lines up ridiculously. And so I think we're back to me, what makes the most sense is to actually close the drive-through. We don't feel that we have that many people that use the drive-through because they can't physically come into the lobby. And certainly if they come to the drive-through, they can use the night drop and they don't have to get out of their car.
Well, that was where I was going with that.
Yeah.
It seems to me like a reasonable thing would be to close the drive-through, and even if you had to install another drop box, do that as opposed to having that open. So
Right. Yeah,
I'm
and
sure
that's
that's something y'all have looked at.
Exactly, and I agree with you. That's where we're heading. Also, remember that drive-through. We pay a fair amount of money every year in operating costs to have that the tube system serviced, and that costs us money as well. So certainly the elimination of the drive-through, leaving the night drop box intact, and focusing on the lobby
and no one
is the
ever
best
hits
way.
it, so it never needs repair or anything like that, right?
I don't know when the last time someone hit that, but I'm sure it's happened on more than one occasion. Yeah, that's the direction that we're leaning. And, again, the idea is to still give excellent customer service. I mean, I think that we've done a great job of that, and I think it's extraordinary if you look at this. It would still be very, very good, but the question you have to ask yourself is where are your percentages? How much money do you want to spend serving the 1%? Versus focusing your money and attention on making improvements that make it simpler and easier for the vast majority of your customers without inconveniencing those people too much. In other words, there have to be a slight behavior modification for them, but a lot of improvements for the majority of your customers.
Have you gotten information on what this process would cost through?
I have some preliminary information. That's what we're working through right now. And when we come with an actual proposal for you in May to then get your endorsement and take it to City Council, we'll have a full one-time cost, monthly cost, monthly savings. We've got some preliminary information. We're working through it because it's very volume dependent. So it's taken some time to put that together.
Okay, but I thought I understood you to say it wouldn't decrease the staff that you require.
It would decrease the staff that we require only if we make the modifications to the lobby and the walk-in and the drive-through.
Okay, thank you.
Yeah, that's where we'll have to go in order for the dollars to work.
Members matters, Catherine?
No.
Noah?
No, sir.
Jan?
Yeah, just one comment on that resolution, which I understand it's already been adopted by council. Okay. It just seems to me, I think it's a fair resolution because it does decrease the rates to the unincorporated area ratepayers, as I understand it. It cuts their rates a little bit. And it surprisingly, I think it brings in a little more revenue to the city, which is you
That's
really
fair
have,
for both sides.
you have to have a thorough understanding to really understand that. But to me, it's a short-term solution. I don't see it as a long-term solution. Maybe I'm wrong, Mr. Chairman, but it's based on that franchise agreement that expires in 2017. So, in other words, in 3 more years, we could be going through this all over again.
Well, you know, the fact of the matter is we've had several meetings. We've been meeting for several months, and this seems to always be the number one item. And so when we were trying to figure out what can we do, because we don't want to be in conflict with the county. That's not the intent at all. And if this is the number one item, we can take care of that real quick and get it out of the way. And it doesn't affect either one of us. And so that was really what we tried to do. The rest of it are going to be details that are going to be pretty extensive in negotiations, and we didn't want the customer to be sort of sacrificed at that point. But thank you very much. I think it's a very fair resolution as well.
Thank you. Anything else? Mr. Mayor, do you have any comments? Any words of wisdom and guidance to? Well, then we will soldier on the best we can with the information. I want to thank you, Cindy, very much, and Jim. I think and Rob too. I think it's been very productive, and the changes that you've made, I think, are going to be most helpful as we go forward. So, with that, do I have a
Move to adjourn?
move to adjourn?
Second.
All in favor? All right. Thank you, everybody.